Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for January 4th, 2014. We have a market that has pulled back into bullish quiet mode. On an annual basis, using weekly RSI 14, we're still overbought at 72 out of 100. The 10-day NDX for the short-term market condition has pulled back to the middle of neutral at 56 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is at 9.6%, or about 7.5% away from the sideways channel. Slope of the 50-day moving average declined to 0.56%. That's white bullish, so it's pulled back a little bit from the strength of last week. ADX has increased slightly to 20.6, still neutral, but the upward trend is getting a little bit stronger. ATR percentage is at the, drifted back into quiet at 0.77%. The risk index, which is the 30-period moving average of the VIX divided by the 10-period, comes in at 1.04, so it's tipped over into risk on. That's value of 1.04 when compared to the last 5,000 days. Comes in with a risk Z score of 0.47. You can see the 90-period time series indicated here, and we're getting back into the favorable side of the owning the riskier assets. The next reevaluation of blended monthly rebalancing is on or about 1 February. The holdings for this month you can see indicated here. No change from last month's in the ETF 13, 22, and 32, with the U.S. large cap still doing very well, along with U.S. tech. I've added the Dow 30, ETF 200, and the ETF Max to indicate the top 5 and 10 respectively of those portfolios. Now, I haven't tested these for holding using blended monthly, but I wanted to show where the strength is. So we're using this for information rather than as a specific documented, specified, and back-tested system. ETF2 still is holding with theoretical exposure at 70% and the model portfolio at 100% exposed. This just a quick update on the ETF 13 and 32, so you can see where the strength is. Again, about half of the members of each portfolio are on a cash position that's priced relative to the 4-month moving average. And then the ETF Max TAN has moved back to the top of the stack. Looking at the market health check, we have the last 10, 20, and 30 days indicated by the vertical blue lines. The horizontal red lines are support levels that have held in the past, they were once resistance, now they're support. If they get violated to the downside, then we would use those as profit targets on the downside. I'm showing the support level at 181 as a dotted red line because we had such low volume in the holiday week that I'm not convinced yet that that's a solid support level. But we'll see what happens going into next week when folks are back from holidays. There was a little bit of selling off here at the in the last couple days, but nothing to worry about yet. The dark blue shaded region is the river, the 30-period Bollinger Band plus or minus 1 standard deviation. The lighter blue shaded area is the floodplain, which is the 30-period Bollinger Band plus or minus 2. The dark red shaded ribbon that cuts through the river is what we call the dragon, or a 10-period Bollinger Band plus or minus a half, and that's a front runner for the changes of trend in the river. And you can see price and the dragon are both outside of the river, right at the edge, so that's a very favorable sign. We've got 3 different RAF regression channels indicated here. the 10 period, the 30 period, and the 90 period, with the 10 period in the blue and the 30 and the 90 each lagged by a day. The 30 period is in black and the 90 in green. You can see they're all steeply sloping upward. That's a very favorable sign in all time conditions. The fact that we pulled back in an orderly fashion to the edge of the river gives us the opportunity to set up some intraday trades upon resumption of the primary trend. That's indicated by the green, yellow, and red regions. When price gets into the green, I certainly want to be long the strongest sectors by that time. When we're in the yellow, like we are right now, I take the intraday trades a day at a time and try to be aligned with where the market is moving on that particular day. If it's in the green, my bias is definitely to the long side. I don't hesitate. By the same token, if we were to violate below 177 and get into the red, that to me puts the bull move at risk, and then would start setting up these next three profit targets to the downside. The sine wave looking thin black line is the slope of the 30-day regression line. I've marked off in the blue circles where it's made intermediate turning points. These blue ovals here represent where the slope of that regression line has gotten to an extreme condition, and we're not there yet, which bodes well for where we are in this market here. We've had one nice move up during the holiday, a measured pullback to the edge of the river, and the slope of that 30-period regression line is not extreme yet, and so that means we still have room to the upside reasonably available. These two dotted lines just represent places where if the market had been oscillating and wanting to go sideways or even retrace to the downside, that's where that slope could have gone negative. But in both cases where it's tested that, in fact, it reversed and went higher on some new buying pressure, and we're still early in that phase, as indicated here in this the turning point of the 30. You can see the 200 period moving average here marked off in red. That's our cushion of safety. We have about a 7% cushion right there. And the 200 period moving average itself in the edge with the looks like lava on the downside here. That would be a return to the bear if price got down into there. You can see on Williams percent R, a good oscillator to indicate overbought, oversold, has been overbought for the previous 10 days. It just pulled back into normal. It can stay overbought for a long time. This is just a measured pullback these last couple days, as indicated by percent R. Percent price oscillator, it does a good job of marking off changes in the intermediate term trend. We've just had this nice move here of the previous 10 days as marked off by percent price oscillator. The jaws just closed, and we're still above the zero line, so we wouldn't give up on this move yet, but it does say that that previous leg up, that previous 10 days was one leg, and we would look to on a rebound here and taking out the new high, we'd look for it to achieve a similar leg up in terms of framing upside potential, which would take us up to about 190 on a technical basis. So we're in good shape here. Let's see what we get next week when the pros come back from holiday. Looking at the ETF2 model and the regions of that model, 7 out of 10 are in a buy signal, 3 are in cash. That puts the theoretical model at 70-30. The actual system is exposed to 100% because the stops are in place and we're in a bull market. But this just gives us an idea of health. The two strongest sectors are the NASDAQ and the U.S. large caps. The two weakest remain Latin America and Asia less Japan. Right now, the S&P at 81 strength is still better than the global at 77, so it's still the U.S. is the story. Inside the U.S., it's technology, large caps, small caps, and mid caps. You'll see, taking a look at the sector spiders through the same lens, that materials and industrials are where the strength are right now. So that hasn't changed for the last month. Looking at the world market model, you see everything in the U.S. is above average, the NASDAQ exceptionally so. China is exceptionally strong, as is the private equity ETF. Everything Europe is strong, Germany and Spain especially so. Latin American emerging markets suffering, along with Asia, less Japan. And really most of the Asian countries are hurting too. Looking at the business sector comparison, the U.S. versus the globals get ties almost across the board, except for finance and industrials, where the U.S. still has a lead. So little change there in the posture of the world market. Still the U.S., still the large caps. The ETF top 30, using the ETF2 database as a lens for information. I like those that are green on strength and white on consistency. That's new money going into that market, and that would point us towards metals and mining, and certainly we'd want to look at Alcoa and Cliffs Natural Resources in the stocks. Natural gas, home construction, technology, again U.S. tech, and basic materials. All of those sectors looking pretty strong. And the usual suspects up top. The solar ETF has returned to the top of the stack, and Greece still in good shape, European small caps, and pharmaceuticals. So the leaders continue to lead going into the new year. Looking at the Dow, Boeing and American Express remain strong. Nike is starting to suffer a little bit, being supplanted now by DuPont, ExxonMobil, Goldman Sachs. And you can see some strength returning to the financials. We've been tracking that for a couple of weeks with American Express, General Electric, Visa, Goldman Sachs all at the top. Only Cisco remains in the red for the Dow. That's sort of a measure of the strength of the U.S. large caps right now, that so many of them in the Dow 30 are in the green for exceptionally above average and white for above average. ETF liquidity, just as a reference, the top 30 most liquid ETFs based on average daily dollar volume. Look at the liquidity in the small caps, almost twice the liquidity of the NASDAQ. So the Russell really just continues to grow in attractiveness to traders. Shifting now to the daily report. And no signals in channeling and overreaction. You can see the time series of %R. Only a couple signals among the swing setups with Procter & Gamble with the VIX, and then the auto framer has emerging markets, VIX, agriculture, gold, and treasuries, testing out better than 2-to-1 on the auto framer. We have a few signals for RSI2. Procter & Gamble I like. It's number 1 on your max pain range compression. It tests out at 2-to-1 on the auto framer, the only Dow component to do so. In the ETFs, RSI2 signals for oil, blended commodities, coal, utilities, and consumer staples. We got quite a few more that test out well on the auto framer, starting with Brazil, oil, emerging markets at 7-to-1. Nothing wrong with that. Here's some auto framer data for you for mechanically computing trade frames, and some of the market mosaics charts. See the nice measured pullback back to the 30-period regression line, consistent with the upward trend, and we're right at the 6-month average, as you can tell. And the decline in volatility is good for the long side. And I'll just flash through the rest of the charts here for reference. This is a shift in gold here. You notice on the swing z-scores that on a 40-day basis and a 20-day basis, gold has been suffering, but the 5 and 10-day periods are above average, and so that we've been framing those trades in the chat room for swing trades, both in gold and in the gold miners. So that's one to keep an eye on. The z-scores of the regression line slopes. The 90 remains strong and out of the channel. You can see it rolling over. That may be a sign of stalling, but it's hard for it to get much stronger than it has been over the last 90 days, is what that says. The 10 has pulled back to the blue line. The last time it did, it had a nice bounce. It has each time it's come back to the vicinity of the median on the z-score. And the 30 continues to look strong. It's still deep inside the river, within the range of normal, so it's not a runaway market by any means here at all. This has been an orderly move, and that's actually a favorable thing because we have not experienced parabolic moves yet. Frog list. The holding period report. And the balance of the charts. That's everything I have for you. So, getting ready for some soccer this weekend and getting ready to back to work next week. And let's see where this market wants to go. Take good care. Keep your trade frames stable and your risk measured